It's the penultimate day before the budget, which is the penultimate budget before the elections in 2024. We are calling it Growth Beyond Resilience out here at BQ Prime. And a very special guest joins in to try and talk about the implications of some of the moves that may happen in the budget, but actually beyond budget, because as we've seen in the last few years, the union budget is not necessarily the biggest driving force, but an important one. Mahesh Nandurkar, who's looked at all of these budgets and events very, very closely for so many years, joins us right now on the show. Mahesh, great having you. Thanks for taking the time out.
Thank you, Neeraj, for having me here.
No, the pleasure is ours. Mahesh, so could the budget really make a telling impact on economy and markets this year, or would its role be to not disrupt the apple cart, if you will?
Yeah, I think very nicely put, Neeraj. I would, put my vote in the second option that you have given. See, the thing is, we are looking at this budget in an environment where there are just too many demands, from the government budget per se, and there is very little scope for maneuverability with the finance minister, given all the constraints that we are. I mean, the first and the foremost constraint is obviously the fiscal deficit. So as things stand today, our FY23 fiscal deficit at roughly about 6.4% of GDP for the central government is roughly 3 percentage points higher than pre-pandemic. And so while the government has made this long-term forecast that they don't need to go back to the pre-pandemic level, but they need to go down to 4.5% of GDP, which is 200 basis points roughly lower than where we are, which means that it requires about 50-60 basis point consolidation. And given the fact that we've already seen the post-pandemic recovery and from a low base, the GDP growth, etc., have been high. So my sense is that next year, FY24, the GDP growth is, the nominal GDP growth is unlikely to be more than 10-11%, let's say. And if you put on top of that, the consolidation by around 50 basis points of GDP, which means that the total government expenditure growth in FY24 is likely to be in single digits. So with that as the backdrop, it's difficult to see, when your total expenditure growth is going to go up by single digits, how many different variables you can really target and what kind of a positive surprise that you can really give.
Yeah, well said. So Mahesh, let's assume that some of those numbers come out as we think of, which is sub 6% or thereabouts fiscal deficit, the nominal GDP growth numbers between 10.5, 11, what have you. But if the government or if the FM assumes substantial savings from some subsidies, my question really that I'm going to probably ask everybody as well and look up for in the budget is that would you be happy if a large portion of that is spent behind capex related themes, or would a judicious mix of that plus a spend on rural make you happy? Because there is an underlying assumption in a lot of people's minds that since this is the pre-election budget, so to say, we'll see a lot of money going there, and whatever little goes there in order to boost the rural consumption, which is also hurting, might actually be construed well. So how would you look at that balancing act?
Yeah, it's a good question, Neeraj. So the thing is that the government has already announced that the extra portion of the food subsidy, which was announced post-pandemic, is now getting rolled back. Now that creates a saving of roughly around $15-16 billion or so on a YOY basis. But I think that's what the quantum of the fiscal deficit reduction also going to be, right? So $15 billion is roughly about 50 bips or 40 bips of GDP. So essentially, my sense is that the food subsidy reduction is going to go into fiscal deficit reduction. Now, the second part is the fertilizer subsidy, because that was also a substantially high number this year, and that was necessitated by the rising raw material prices, etc. Now that's not the case anymore. So there is probably a case for some savings to come through by reduction in the fertilizer subsidy as well, without really reducing the benefit as such. It's mostly like a cost driven and not really the benefit driven reduction that we are looking at. So that part of the saving would be available. And I guess that's the reason why I personally feel that while the total expenditure growth is going to be in single digits, the capex growth is probably going to be in double digits, say around 12% or so. And my sense is that it will be worth spending a little bit more on the on the capex side, because ultimately, what is capex? I mean, capex ultimately goes towards whether it is roads or railway or ports or whatever kind of construction activity. It ultimately goes into the pockets of bottom of the pyramid, right? And you end up creating employment at the bottom of the pyramid. So I think it's the kind of an expenditure which can actually give you the benefit on both sides. One, you are investing behind growth and creating infrastructure, creating assets, etc. At the same time, creating jobs at the bottom of the pyramid as well. Obviously, if you spend like X amount of rupees on capex or infrastructure, probably 25 to 30% of that will be the labor component, and that's what goes in. Whereas maybe, if you want to create a purely social scheme, then obviously technically even 100% of that expenditure can go into a social scheme. So I guess the government will have to walk the fine balance between the two, because there is a very clear understanding, not just in the capital market and in the investment community, but also very much in Delhi, that the post-pandemic recovery has been K-shaped, right? And as you rightly said, it's a kind of a pre-election budget as such. Although technically not so, because now that the date of the budget has been advanced 1st of February, so that still leaves a good 3 months or so before the next election as well. And in fact, if you remember, in May 2019, I'm sorry, in February 2019, which is before the previous elections, this new farmer cash scheme was rolled out just 3 months before.
Yeah,
the government did manage to roll out first tranche of the payment before the elections were held. So it's not necessary that everything that the government wants to do has to come in this budget. Something can come in the next budget as well. And the other point that you made right in the beginning, Neeraj, that it's not just the budget. There are many other avenues for the government to make these adjustments and make this announcement. And budget is just one of those platforms, but not the only one.
Yeah, true. So net, if we are assuming that we are all hoping that the budget doesn't disrupt the apple cart, if you will, Mahesh. The other big event that the markets will be focusing on this week would be, might be the FOMC outcome and some change in language, if you will. Are you looking out for that, or is it a bit of a foregone conclusion?
No, so I think if you had asked me this question about a month or so or 2 months ago, then probably the expectation was that very firmly that this week's FOMC will raise the rates by 50 basis points. But that's not the case anymore. I think there is a reasonable chance that it will probably be lower than that at 25 bips or so. So to that extent, there is probably going to be some softening in the commentary by the FOMC. And yeah, we can debate whether it is going to be 25 or 50 and how many more 50s or how many more 25s. But I think it's a fair conclusion that the Fed is going to be hitting the peak rate, say, in a couple of months' time, somewhere around 5% mark, whether it is 5 or 5.25 or 4.75, that we'll see. But I think it's pretty obvious that sometime around March end and sometime around 5% mark is where that peak is going to be. Obviously the market and the investors will be, are already looking at what after that, and the scenario of the rate speaking out. And I think that is going to be a positive development, according to me, especially for emerging markets, because when the US Fed rate peaks out, it also usually signals the peaking out of the USD strength as well. And peaking out of the USD strength usually augurs well for emerging market investments.
Got it. So, Mahesh, if there is nothing untoward in the budget, in that the distribution of capex versus pro-poor policies is equitable, the glide path is normal, the fiscal deficit is normal, so on and so forth. And two, the Fed policy or the Fed outcome, again, is as they say, madhya marg, if you will. What's your sense around what happens to equities? The last week the Indian markets have been rocked by a beyond budget item of the report, the Adani Group stocks coming off, the sentiment coming off, banks coming off. What happens to equities in a case of both the budget and the FOMC being non-events? I know I'm asking for a very short term. We'll move to the medium term too, but because the short term has had a lot of variables of late, I'm forced to ask this to you.
Yeah, no, that's a fair question. See, the thing is, the Indian markets have generally been moving sideways now for the last 15, 16 months or so, since the peak that we saw in September 21 or October 21. And my general sense is that, over the period of the next, calendar, or, the current calendar year, unlikely that we will see any large moves, from here on, because the valuations is still, are a bit on a higher side, and especially looking at, where, the risk to the earnings estimates are, those are on the lower side, because, we are still looking at the global slowdown, recession, etc., etc. And, even from the Indian standpoint, we have seen some, some pointers that the urban discretionary consumption growth is showing signs of peaking out. So my sense is that essentially for the CY23, we are looking at another year of a broadly sideways movement. Maybe the Nifty goes up by, another 1,000-1,500 basis point at, at max. So that's the kind of, outlook that we're looking at. So that's what I would say, my outlook for CY23 will be. From a more shorter term perspective, yeah, I mean, we can see some, some excitement, and we can see some bounce back, given the recent correction in the markets, and, as you rightly said, some softening of the FOMC commentary. But unlikely that it really changes the trajectory and sets you into a new orbit. I don't think that's really a likely scenario.
Okay, Mahesh, in which case do the components within the stability changes? I mean, we had near zero returns or marginal returns in 2022, but individual pockets did really well, as they do every time, just that the nature of the components changes. So I'm just trying to understand if you believe that in a flat year for 2023 as well, likely flat year for 2023, assuming that no negatives come up from the budget or FOMC, do the components change materially from what people are betting on right now? There is a belief that banks, maybe to an extent autos, so on and so forth, might do well. Discretionary consumption might come under a bit of pressure. IT may stay sideways. That's most generally the common belief. I'm trying to understand, how are you thinking about this mix?
I think the one thing that will definitely change, according to me, in CY23 versus CY22 is that the last year we saw a very soft trend from the rural demand, from the bottom of the pyramid. And generally, the high income, the urban discretionary segments and stocks did pretty well. My sense is that is now due for a reversal. Some part of that is being visible, but I think more so, because I think on one hand we are seeing signs of the urban discretionary growth topping out. Obviously, the post-pandemic, the pent-up demand is now behind. The base has caught up as well. So we are doing a tough comparison on a YOY basis. And at the same time, the rural or the bottom of the pyramid demand growth has been pretty weak. But now with a couple of years, or maybe at least 18 months of the economy broadly opening up, there is some sense of stability at the bottom of the pyramid as well. And my continued belief is that as the construction cycle, the investment cycle unfolds over the next couple of years, it actually ends up creating more jobs at the bottom of the pyramid, and basically the rural labor comes into the into the cities and send money back home, which is an important part of the rural economy, which was missing over the last 1.5 years or so, which is now slowly getting back on track. And the other point that we discussed earlier, which is it's ultimately a pre-election year budget and pre-election year in general, and there should be some some propping up from the various governments for the lower income strata as well. So my sense is that one change of trend that we should be looking forward to is an improvement in some of the bottom of the pyramid stories like the consumer staples, the two-wheelers, some of the select NBFCs as well. And also some of these sectors, especially the FMCG, will also see the benefit of lower raw material prices as well. So that I think is going to be something that should be changing in 23 as compared to 22. The other big thing that the investors are looking forward to in 23 is the IT versus banks. That's usually a very sort of interesting trade, and usually when one sector outperforms, the other does not, by and large, if you look at the history. And given the fact that IT sector has underperformed quite a lot last year, there is some merit in evaluating the sector as a possible outperformer in CY23. Although my personal belief is that it is still too early, and my sense is that while the margins are showing signs of improvement in the IT sector, but the revenue still leaves some scope for downside revisions as we go forward. So I'm not really of the camp that is overweighting IT just as yet, but yeah, carefully evaluating it for a possible change in the trajectory.
That would be interesting. Companies will come out and say that, hey, we told you so, then our growth numbers are okay, and it is not too much of skittishness around that. My final question, some pop-up themes that came out in 2022 the jury out there is split, Mahesh, about whether they can continue it. It could well be defense, PSU banks, or PSUs in general. And to an extent, the small uptick that we saw in autos, and if the numbers recently are to be looked at, I think the results this quarter, they are all continuing to show that strong growth, at least for the December quarter. So what happens to the whole PSU pack, be it defense, be it railways, be it PSU banks, what have you? Do you reckon the momentum continues, or is it difficult a call to make?
Yeah, I think the banking sector in general is looking in a pretty good shape with all the variables like the NPLs cycle is behind, the credit costs are still coming down, the credit growth has peaked out. Maybe the credit growth will slow down from where we are, but still should be reasonable in the range of 14-15% for the sector as a whole. And yes, there is some NIM pressure that will be expected, but I think the banks can possibly offset the NIM pressure by going a bit slow on OPEX growth. So I think broadly speaking, the pre-provisioning profit should still show a robust growth. So I think the banking sector in general is in good shape. Now within that, the state-owned banks, I think the state-owned banks still offer a reasonable a reasonable upside, in the sense that there is still a large discount that they trade at, above average discount that they are trading at. So I would say that it's still a good news for the state-owned banks going forward. So that is something that should continue. The other themes that you mentioned, whether it is like defense or I think like chemicals, I mean, those are, I would still say more stock specific ideas. I mean, while one would like to put it as a theme, but ultimately, I mean, you got like, few stocks, are, there. So I think then it becomes more like a stock specific story, as such. But the other theme, which, continued well on the ground, but not so much on the stock markets, is the housing side. The housing sector stocks did not really do much last year, although on the ground you can see the volumes, the pricing, everything is going the right direction. And the reason why the stocks did not do well is the perceived notion that rising interest rates is bad for the sector, which actually it is not. But but that's the general perception of the stock market investors. But now that the rates are also close to peaking out, not just in the US, but also in India as well. I think that should help improve the sentiments around the property stocks. The physical property sentiments are already quite good.
Yeah, and it's a theme that I think you guys have been at the forefront of talking about as a multi-year cycle now for the last 2 years as well. But yeah, you're right. 2022 was, the second half at least, wasn't quite the strongest year for the stocks at least. But Mahesh, take a moment to thank you for joining us today and giving us your thoughts on the budget and whatever little is important there, quite a bit, but thank you for doing that. And thank you for giving us some color about the year. It was good to do that at the start of the year, and look forward to having you more often on our forum.
Thank you, Neeraj. Thanks a lot.
Now, the pleasure was ours. Viewers, thanks for tuning in.